The 5 factors that go into the credit score are important to be familiar with so that you know how to control your credit score. So the first one we're going to talk about is paying on time. Paying on time is 35% of your FICO score. And when I do talk about credit scores, I'm always referring to the FICO score because that is the only credit score that is used in the mortgage lending world. Since the end of 1994, beginning of 1995, the FICO score has been used, and there is no other credit score that is being used in the mortgage field. Everything is always referring to the FICO score in everything that I'm teaching. 35% is paying on time. Our definition of paying on time is going to be paying within 30 days of the due date. So as long as you pay within 30 days of the due date, you are going to be considered on time. And so that's ideal because if you're late, it's going to have an adverse effect on the credit score. And that is going to vary depending on how much positive credit you already have established. Definitely, we want to make sure that we're not late on anything. And if you are late on something, it's always a good idea to pick up the phone and call and see if they will remove that late. Sometimes they will, sometimes they won't. It doesn't hurt to ask. If you ever find yourself in that position, don't be afraid to pick up the phone and at least ask. The second largest factor is going to be the total debts. And the largest influence that I typically see is the balance on credit cards that people have. How much of their credit limit that they're actually using has a pretty big effect on their credit score. If somebody maxes out all of their credit cards, that could knock them down anywhere from 50 to 100 points. It just depends on their overall credit profile. So it can be pretty significant, especially when you measure it next to paying on time. It's only 5% off. So that's a really huge chunk of what is being considered in the FICO score when you look at it from the standpoint of balances. So you have to really look at it as a ratio in terms of what is my credit utilization ratio based on my available limit and my current balance. So for example, if I have a $1,000 available limit and I have a $900 balance, I have a 90% credit utilization ratio. In the same scenario, if I have a $1,000 limit and a $100 balance, I've got a 10% credit utilization ratio. Lower is always better. We want to keep that balance as low as we possibly can. That's what's going to help the credit scores to be as high as they possibly can be. So if I know that I'm 60 days out or 90 days out from applying for a mortgage or going to apply for a car loan, if I want to get my scores as high as I possibly can, I should probably go ahead and start paying my credit cards down. So that way, by paying it down, it should increase my credit scores. Keep in mind other things are obviously being considered in the credit score. But if I can keep the credit card balances low, then at that point in time, my credit scores are probably going to be as high as they could be. So always make that a focus. So try to keep your credit card balances as low as they possibly can be. The next one is 15% length of history. So length of history, how long have you had credit? In order to be a good credit risk, a lender needs to be able to look at that credit report and see that there's a history of repayment. And that's really the purpose of the credit score, is to kind of make that decision easier for the lender. So if the lender says, okay, as long as they have this credit score, then we are fine with that. Now there's more that goes into it than just the number, but it really helps speed up the decision for the lender by having that credit score. For somebody who has well-established credit, they've probably had plenty of opportunity to demonstrate that they will repay stuff when they borrow. And that's the big issue, is if you get this loan, will you pay it back? That's really what credit's supposed to tell that lender. It's going to help them assess the risk of, if we lend this money to you, what's the likelihood that we're going to get that back? So when it comes to length of history, one thing that you really need to keep in mind is the fact that credit cards have this indefinite nature where they are super powerful in their influence on your credit score. Here's an example. If you've had a credit card or multiple credit cards for more than 7 years, there's really no reason why you should not have an 800 FICO score. If you have at least one credit card that's over 7 years old, you can get to an 800 FICO score. I have seen it happen. Now, here's the question. How many credit cards should I have? Well, there's really no specific answer to that. You want to have enough so that you've got established credit and you have room if something were to happen where one of the credit cards got closed. You want to make sure that you wouldn't be left with no credit. So I would generally say at least 3 is probably a good idea. Definitely 1, but what happens if that one credit card gets closed down? Sometimes credit cards get closed down to inactivity. So you want to make sure that you are using them at least once a year. So if you're doing that, it shouldn't be closed due to inactivity. But if you have more, you are building a layer of positive credit that is going to last for a long time. Because think about the oldest credit card that you have. How old is it? How much benefit is it having on your credit score? I had a client this client had the highest FICO score that I've seen on paper. So if the classic FICO model can go to 850, he had an 841. So he was 9 points away from being perfect. That is amazing. And I know other people have scores in that range, but that's the only one I've seen on paper. So it's not a real common occurrence, but there was one credit card that he had that was having a major impact. He had had this credit card since 1965. So he'd had this credit card for close to 40 years. And if he had closed it a long time ago, he probably wouldn't have an 841. Now he'd have a good score still because he had other credit cards that were there. So if something ever happened to his oldest credit card, he still had other credit cards that weren't 40 years old, but they were generally 10 to 20 years old. So they're still good. They're still going to put him in a very good range because your goal for your credit score should be to get above 740. If you can get to that 720, 740 range, you're in a good range. But if you can go higher, hey, great, because at least you're giving yourself a bit of a cushion. Generally speaking, if you have at least a 740 FICO score, you're always going to get the best terms. You're going to be considered cream of the crop. So if you have a 740, you're in that VIP area. If you have a 800, guess what? It's actually kind of the same as having a 740. It can make a little bit of a difference, but not a whole lot. Really, once you get above a 740, you're already in the club. But going higher than that gives you that cushion. Because what if you get an unexpected collection? That's what I see happen to people that have good credit, is something unexpected happens to them, which is why you should establish more positive credit, because you don't know what's going to happen in the future. You don't know what unexpected thing might happen. What if somebody steals your identity and it's like a couple negative things show up that you have to deal with? Maybe there's a collection that falls through the cracks. Maybe you co-sign with your kid on something, or you sign a lease, something like that, and it doesn't get paid and ends up in collection. There's so many possibilities. Based on what I've seen in the past, I would definitely recommend establishing somewhere around 3 to 5 credit cards that you're just going to plan on having for the rest of your life, that you're not going to close, because it's not going to do anything but be positive as long as you're paying them on time, as long as you're keeping the balances low, and as long as you just keep them open. And don't forget about inactivity. Use them at least once a year. I probably on a monthly basis, I see a credit report where the credit score is average. Let's say it's like 670 to 700. So a very average range. Are they getting the best interest rate? No, they're not. They're not getting the best interest rate. Are they getting the best terms on their homeowner's insurance? No, they may not be. Are they paying the lowest premium for mortgage insurance if they're going with a conventional loan? No, they're paying more because they closed things out because they thought credit cards were evil. Somebody told them credit cards were evil. Maybe credit cards are evil for somebody who can't control their spending. So I'm never going to say that you should have credit cards if you've struggled with credit cards in the past as far as not using them when you shouldn't. That's a whole nother issue. Focus on that issue and less on the credit score. But if you have that under control, credit cards are nothing but a positive for you the older they become. So keep that in mind. Don't close those credit cards because it could push your score down. You're taking away history. View it this way. When is the best time to plant a tree? Is it yesterday? Is it today? Is it in the fall? Is it in the summer? The answer is the best time to plant a tree was 100 years ago. But you weren't here 100 years ago. So maybe you're here 25 years ago. Could you have planted that tree 25 years ago? But did you? If you didn't, the best time is today. Today would be the best time to plant that tree because you need it to grow. You need it to turn from a seed into a tree and just get bigger and bigger and bigger. And that's exactly the analogy that you need to envision when it comes to a credit card. You've got to get started. You've got to put something on that credit report that's going to grow and give you more and more of a positive history. And that's what credit cards allow for. So, and believe me, I don't want to see you pay high interest rates on credit cards. I would rather you pay them in full so that you're not paying any interest. There's no reason to pay that interest because it's too high. You need to be saving that money. A whole nother topic there. But do yourself this favor. And I say do this as a favor to your future self because someday you're going to want something bad enough that you're going to really, really appreciate that you have good credit. Believe me, the time will come. Because people who say, oh, well, I don't need credit. Guess what? Something's going to happen where they're going to need credit. There's two reasons that we need credit. Opportunity and survival. One of those two things will happen to where you're going to need credit. It's nice to have cash. It's nice to save money. It's nice to try to be all cash. I would never disagree with anybody who's trying to do that, but I wouldn't turn a blind eye to having established credit because I've seen people who don't have credit cards who can't travel across the country for a funeral for a family member. And then they have to go to a friend and say, hey, can I use your credit card because I can't get a hotel? I can't rent a car. I can't do this. I can't do that. That's one of the problems with it. Debit cards are nice, but debit cards are risky because that's directly to your checking account. And with all of these security breaches that we've had, do you really want to use your debit card out there in the world? I personally don't. So credit cards are good in that sense. There's a lot of protections that they afford us in terms of limiting liability. And so it's a good idea to have it because when you need it, you'll need it quick. And I've seen this happen. I've seen this evolve with my clients. I've seen clients who were in really, really, really good shape financially, and they could basically get anything that they wanted at that time. And some of them did. It's like you want to set things up when you don't really need it, because when you don't need it, that's when it's the easiest to do. When you do need it, that's when it's the most difficult to get. If I lived in a hurricane area, I would keep plywood in my garage. I would keep batteries and I would rotate those out. I would have canned food. I would have bottled water. I would have a box of flashlights. I would have a generator. I would have gasoline. I would have all this stuff in preparation of a hurricane. But what do we see on the news about a day before the hurricane is hitting? People are emptying the shelves. People are fighting each other at the grocery store for the last can of soup because people don't prepare. So you want to be prepared for that. What if you wanted to start a business down the road? Is that something that you've ever thought about doing? You're going to need some credit for that because to get business credit, it takes personal credit. And in fact, I wrote a whole book on that subject. So I can tell you it does take personal credit to get that going. So really important that we establish it. The credit cards really afford us this means of you open them and then you just let them function. You pay them on time, you keep the balances low, and those will just continue to become better and better. So that's 15% is length of history. The next one is 10% new credit and inquiries. So if I get new credit, that's going to factor in. If I apply for credit, that's the inquiry, that factors in. So we could really kind of split those in half and say 5% is new credit, 5% is the inquiry. So when it comes to a mortgage, you can go to as many mortgage companies as you want. in a specific period of time. Generally keep it to 30 days. It's actually like 15 to 45 days. It depends on the platform that lender is using, but generally 30 days or less is advisable. But I don't think that I would want every mortgage company in town pulling my credit, giving me quotes. I'd rather just call up the loan officer and say, hey, here's my scenario. Oh, and by the way, I went to myfico.com and I got my FICO score. So I know exactly what my FICO score is. It's a 745. What would be my interest rate if I have a 745 and I'm putting X amount down on this loan amount? They should be able to give you a rough estimate of what your interest rate would look like for that day's pricing, because the rates can change, throughout the day or daily. They do change as the market changes, and what your closing costs are. So once you know that ballpark figure, really it's about the loan officer. It's about, do you like this person? Do you think that they're going to answer your calls when you have questions? Are they responsive? Do you trust them? That's more important than saving $100 on your transaction, believe me, because at the end, if you're not closing on time or you're just plain not closing because your loan's being denied at the last minute, you will be glad you went with the person that you think is the best. So that's the mortgage stuff. Applying for a credit card that you don't need, I wouldn't do that. I wouldn't apply for a credit card just to save 10%. I would apply for the credit card if I go to that store on a frequent basis and it makes it easier. Or if they're incorporating a discount, like if I'm going to save 5% every time I go to that store and use their credit card, hey, that's great. I'm saving 5%. What's my goal? My goal is to pay that credit card in full every time the bill comes. So nothing wrong with applying for credit. Just don't apply for credit that you don't need. That's the thing, because eventually it will start to affect the credit score. Last one is 10% as type of credit. Installment versus revolving. Secured versus unsecured. The best account is generally going to be the mortgage. The mortgage shows stability. You've got a house. You're not going to be moving away because you own a house. You're easy to find. People who have mortgages, their credit scores are going to be slightly higher than people who don't have a mortgage, because if you don't have a mortgage, maybe it's easier to go hide from creditors. I'm not sure exactly if that's the reason, but probably pretty close. It doesn't necessarily matter the type of credit that you have, as long as you have credit and as long as you pay it on time and as long as there's not bad credit on there. As long as you are avoiding collections, if you're avoiding late payments, and if you're avoiding maxing out your credit cards, your credit will be okay. If you look at your credit report at least once a year to make sure everything is correct, then you're really doing everything that you should be doing. But also keep in mind, you should be saving a copy of your credit report every single year. This is important because the credit report constantly changes. If you ever needed to prove something, as far as a date, maybe there was a collection and okay, this collection can only be there for 7 years from the date that it was first reported, but it keeps getting transferred to different collection agencies and they keep changing that date and trying to restart the 7-year clock, you need to be able to protect yourself. If you save your credit reports every single year that you look at them, you've got your evidence. Believe me, it can come into play. There are court cases out there where I'm sure that people wish that they had saved their credit reports, because it would have made life a lot easier to be able to just prove that date. So save that with your important stuff. So that's a basic synopsis of how the credit score is determined. I'll see you in the next module.